Hello, everyone. Welcome to the market update for Tuesday, March the 30th. What we're continuing to see is a trend that is still intact. But as I mentioned in the last update, the Nasdaq 100 and the Russell 2000 charts are kind of broken now. They've kind of rolled over. And so what we're going to see as we go through the update today is we're going to see a lot of signals that are saying that everything's fine. And even when we look at the VIX, it's going to say that there's no concern of any major pullback. But then you go back to those charts and those leadership charts breaking down, and you just have to wonder if this is the beginning of a bigger correction that's coming. Now, the tough part about being a trend trader is that you don't want to get in the habit of making wild predictions. Even though you see things that are developing, you want to focus on what the current trend is, what is actually taking place. One thing that's possible is that the market starts taking off again, and these stocks, the Nasdaq 100 stocks and the Russell 2000 stocks start going on a tear, and they start outperforming everything else, and all those charts look different, 2 months from now or something like that. So, and you'll be kicking yourself for not just sticking to the current trend. The other thing, though, is you could ignore the warning signs of the Russell 2000 and Nasdaq and just say, well, the other indicators aren't showing any concern. I'm going all in right here. I'm pressing my bet, so to speak, and then it could collapse very quickly, have a big sell-off, and then you're wiped out, or you're significantly hurt. So so I kind of present a balance to that, where you look at the warning signals, you respect the warning signals, and you just adjust your trading. You don't be as aggressive and get into tons of new positions when you're in these types of conditions. Now, what are those types of conditions? Let's kind of go through those. If you look at the indicators here, one thing that kind of stood out to me is you have this right here is showing you've got breadth. Let me change my pen color here. You've got breadth, which is the green line right here, above momentum, which is the red line, which is above sentiment, which is the blue line. That's actually a sign of a healthy trend, a sign that the market could continue to move higher. And by the way, one of the things I did talk about last update was that I expect with the rebound in the S&P 500 and the Dow, I expect those stocks or those indexes to go to new all-time highs, to break out again and go to new all-time highs. I just don't expect the Nasdaq 100 or the Russell 2000 to participate and go to new all-time highs. So we'll look at those charts here in just a little bit. But so this is saying that the trend is looking good. I mean, it's looking like we still could move higher. Okay. And so that's why I think that maybe what we're seeing is just like is a little bit of an early warning signal that maybe we do have another week or so where we continue to rally. Maybe we rally into the end of this month and into the quarter, which is tomorrow, end of the quarter, and then we'll see what happens in the beginning of April. Who knows? But again, that's a very bullish signal right there, forming on those. And we can see by the individual charts that momentum is still not in extreme. It's in the buy area there. Breadth is getting into extreme, but it's not. It's in the early stage of that extreme. It could become even more extreme. And sentiment is you have a high level of complacency, but it's not extreme yet. So there's still some room to run there. Then when you look at the buy-sell ratios. We have the sells outpacing the buys. So there's room for the market to rally and have those buys take off again, those sells drop down again. There's still room there for a rally to take place. Although you could also make the argument that maybe the market is going to roll over and you're going to see those sells really take off and the buys dip down. But I think with the fact that they started to move back together here, and then they've kind of flattened out a little bit here. I think we'll probably see as the market rally a little bit higher and these cross back over again. But this is not showing any sort of extreme condition at all that you'd have to be worried about. Same with the sentiment chart. You're not at an extreme level. Now, if we get a good run, a good rally for a few days, I could see these getting to those extreme levels pretty quick. But there, again, in the near term, there's nothing that's signaling that this trend is going to roll over. But then when we go and look at the individual charts, this is what I want to kind of focus on a little bit. So you can see that the SPY chart is still looking fine. You've got higher highs, higher lows, higher low right here, higher low right here. You're very close to breaking out to another all-time high, which I think will end up taking place. And now you have a little bit of a pullback, a little bit of kind of a flat right here move the last couple of days. But that's actually bullish when you have this move up and then you're moving a little bit sideways. It's showing that should continue to move higher once that kind of pause is complete. You look at the Dow chart. It already had a new all-time high close yesterday. So these trends look fine. And so what's that's telling me is that the money is pouring into the more established companies. It's coming out of the riskier trades, which you'll tend to find those riskier trades tend to be technology stocks. So that's why the Nasdaq 100 is kind of affected, and they really tend to be some of the small cap stocks. So that's why the Russell 2000 has kind of been affected. And so money's going into Boeing and Walmart and Home Depot. If you look at the chart of Home Depot over the last 3 weeks, man, you look at it going straight up like that, and you say, man, I wish I would have gotten into that down near the bottom there. That's been on a tear, and so there's still stocks going up, but they tend to be more of the established, larger companies where people feel a little bit safer investing. They don't feel like Home Depot is going to go out of business tomorrow or suddenly stop making money. But electric vehicle stocks, where some of these companies don't even have a car yet, they're just a plan to have a car, there's a lot more risk there. Those companies could be gone overnight. And then we look at Nasdaq 100. And again, for those that I've gone over this a few times, but those that are kind of new to the update, you can see where this trend was broken. If I draw a line straight through here, it broke it. I know it's not a straight line, but basically it broke that trend, rallied back to it again. Now, I still think it could rally up a little bit further because this looks like a kind of a little bit of an impulsive move. You had an impulsive move down, impulsive move up. This looks a little bit corrective right here, a little bit back and forth. It looks to me like it's possible we can see it rally up a little bit and then roll over. This could be a bearish ABC pattern right here that's forming, correcting that move, that larger move down. And then this could roll over and have another bigger move down. I just don't see it getting back up here to break out to new all-time high. Now, like I said earlier, that could change. There could be a change in market mood and a reason for traders to take on risk again, and they could jump back into these stocks and and it could go higher there. But typically, when you break your trend, your longer term trend, that's usually a warning sign that there's a problem. It's Houston, we have a problem at that point. And the problem doesn't always show up immediately. You don't always see a drop immediately, but like I said, usually most market pullbacks, big pullbacks, I've been doing this a long time. Most big market pullbacks have warning signals ahead of time. And, once I learned to kind of recognize those warning signals, your prediction is not always exact or perfect. I still can't on a consistent basis predict exactly when a big sell-off is going to take place, but I've been pretty close on a lot of these. The big drop we had back last year when the virus hit, there were a lot of strong bearish signals that were showing up about a week before it happened. And I was out saying, you can probably go back and listen to those updates. I was probably about a week early saying, hey, we're getting ready for a pretty big correction here. Didn't think it was going to be that as big as it was, but there are warning signs that start to show up. And the problem though is, do you have the discipline to kind of follow them or to react to them? And that's kind of what my suggestion is today is that, it doesn't mean you get out of the market completely. But you might, if you're getting into, 3 or 4 new trades a day, maybe you get into only 1 or 2 new ones, or, keep a little bit more money in cash, be a little bit quicker to stop out of trades if they start to roll over on you. Little trade decisions you can make that can help protect you in case the trend does start to roll over. Because the problem is when markets break and they start selling off, they sell off very quickly. I mean, if you look back here, what was this, about a month, 3 or 4 weeks, and within 2 trading days, you wiped out pretty much that whole move. 2 or 3 trading days. So you go up slowly, but you drop quickly. And, because the problem you can run into is saying, well, I'll recognize when it starts selling off and it starts selling off big, I can see there's a problem, then I'll get out. But like I said, within an hour, you could wipe out 2 weeks of a rally, and you might have even turned your big gain that you've had over those 2 or 3 weeks into a loss. And then what you do is you play the game of, oh, well, crap, I should have gotten out. Why didn't I get out yesterday? And then you're like, maybe it'll rebound and I can get back. If I could just get back to break even, then I'll get out and there won't be any harm done. And then the market rallies a little bit and gets you back to break even. And you say, oh, that was pretty quick. Maybe it is going to go back up again now. And I could actually get back to my profit again. So you stay in the trade, you don't get out, and then it has a bigger drop down and you're right back to holding on and hoping it goes back up again, which is not a strategy. So if that sounds like what's happening in your trading, it's because it's human nature. It's what happens to everyone. It's what we all have to fight. But that's why we have to be looking for these signals, is because those drops, when they happen so quickly that you have to kind of prepare for them ahead of time a little bit. And you can do that by, reducing your exposure, or, even you could even with stocks you're in, you can kind of buy that insurance for them by buying a put. You could buy a put option. What do put options do? Well, if the stock goes down in value, those puts go up in value. And those puts are cheap compared to the shares of stock. So if you have a bunch of shares of Apple and you don't want to sell Apple, but you think a pullback could be happening, you could, buy a at the money or out of the money put, out for however long you think it might take for the market for that stock to maybe sell off. And if it sells off, you can protect yourself from some of the losses. If it rallies, never drops, well, you did have to pay for that protected put, but it was, you look at it as kind of like an insurance policy in that situation. But there are steps that you can take to manage your trades in those conditions. Let's stay on the 1-year chart and look at the Russell 2000. And you can see that this one has broken that uptrend as well. It's kind of rallied back to it. But there again, it looks like it could maybe rally up here a little bit further, kind of a bearish ABC and then drop. I just don't see it getting back up to a new all-time high. So you have the Dow and the S&P that are right. Dow has already gone to a new all-time high. S&P is right there, but these are lagging. And you've also come all the way back down. Now you look at the extremes, you probably haven't gone to a lower low. It's kind of an equal low right there. But the fact that you came all the way back down to that is kind of a warning sign. You can already see if you connect the tops of the trend. You see me do this sometimes where I'll just connect the tops. You can see that it's already starting to look like it's rolling over. You have when you're moving up steadily on the tops, and then you start moving sideways, that's usually a warning signal that things could be rolling over. Now, it doesn't always roll over. If you connect the tops through here, started to roll over here, and then took off again. But here you had a higher low right there. Here it's come all the way back down. Again, it's just you're seeing momentum start to shift a little bit, and it's a little bit subtle. And it's easy to talk yourself out of it. I can always find arguments to say, well, it didn't drop to a lower low right there, so it's going to rebound off that, take off again, and everything's going to be fine. It's possible, definitely possible, but not probable yet as far as what I'm seeing. So if we zoom back in again, here's that sharper move down. I think this whole bounce was wave A. It dropped a little bit right here for wave B. And I think if the Dow and S&P break out higher, these will move up too, but they'll kind of be that wave C of that correction. And then when things roll over, I think both the Nasdaq 100 and the Russell 2000 are going to lead the way down. They're going to have the bigger moves down, at least initially. All right, let's go through some other charts here. The bonds continue to be in that downtrend. They bounced a little bit back here, rolled back over again. They're starting to move lower. Bond yields continue to kind of inch their way higher. Gold we were looking at this as just a possible correction within the downtrend. You had the sharper move down. This is a little bit more choppy as it rallied back up. You had the big move down today, so it's continuing to move in that downtrend. Now, one thing to point out with gold is that we are starting to get to extreme oversold condition. There's still room for it to move over to the far left side of that, but we are in that extreme range. So what I would expect is that as the trend in gold continues to move lower, as we break to a lower low, we haven't done that yet, but as we break to a lower low, I think we'll start to see that gold will get into that extreme oversold range, and could be setting up for a decent bounce where it could rally a little bit. Now, it may not be a real strong rally, because if the downtrend is still intact, it could rally kind of like this rally right here. That would alleviate the oversold condition, but that's really not a real strong. Put it this way: we talk about the stair step all the time, and when you're stair stepping up, and then you're stair stepping down, the danger sometimes is that, especially if you're trying to pick a bottom, is that sometimes you'll get a rally. I might be able to pick this bottom and get a rally, but if it's a correction within the downtrend, if it's kind of stagnant back and forth as it's rallying back up, then I don't make very much money, but I'm at risk of it rolling over and having this bigger drop. So the reward to risk isn't great. Trying to pick that bottom here, if it's not the bottom, if it continues to move lower, it continues to trend lower. I might get it. I might make money, but it's the amount I make isn't worth the amount I could lose if I'm wrong. The reason why we like to find, as trend traders, like to find these nice healthy trends is because you flip flop that risk reward ratio, where if I'm buying on a pullback within the uptrend, then if this does continue to go down, I could lose a little bit of money. But if I'm right, the amount I gain on the move up, the trend continuing is usually more than what I'm risking or would lose if I'm wrong. And the ratios are just better when you're in a nice, healthy uptrend. Not to mention the momentum's there, and usually the fundamentals are there, and those other things that would make it more likely that for that stock to go higher. So just keep that in mind when you're, if you like to, some people just their big thing is they want to be able to not only get in at the bottom, but be able to brag about getting in at the bottom. And I haven't met too many of those traders that make money. I mean, and most of them, they may have made money once in their life picking the bottom, and they like to brag about it, but they've got wiped out several other times because they're going against the trend. The probabilities are not in their favor. And so if you really think that gold's going to go higher, the trend isn't suggesting that just yet. We'd want to see it start acting like an uptrend again. And when it did start, if you look at longer term chart of gold, if the uptrend did start to, if we did start to see an uptrend, meaning it's, now you're getting impulsive moves up, and your corrections are more of those choppy pullbacks. Once you can recognize a reversal, there's still plenty of money to be made as that thing trends back up again. You don't have to be Nostradamus and pick that exact bottom when the probabilities aren't in your favor. I mean, this gold could end up all the way down here, a lot lower than where it is right now, and you'd be broke by the time you accurately predicted the bottom on that. So there's still room for it to drop. Oil, now oil, you've had a little bit of a decent pullback here in oil, and it's been really volatility back and forth right into here. Now, I'd have a tendency to say that's corrective. So you had this first move down. That's probably wave A. This is probably wave B, and you probably have another move down for wave C, and then I can expect oil to continue to rally again. That's just the behavior right now that I see. With it going back and forth right here. And so, but, it doesn't always have to follow that. This could have been wave A, wave B, wave C right here. But if that was the case, usually you'd see a sharper move up. It'd be a more definitive move up off the bottom. But I've seen that before where it just kind of keeps moving back up again, and it breaks out. If it breaks out again, then that was your correction right there. But so bottom line is I would lean more towards another move down based on that behavior. But, there's not a real definitive direction right now as to where it's going to go. And so I'm just kind of, I don't see a real strong signal saying it's going to go right back up right now. And, but the trend, it just, to me, it just looks like a little bit of a bigger correction within the larger trend. The dollar continues to move higher, so we're assuming it's going to continue to go higher. Now, that could be a little bit more bearish for the market. The market likes a weaker dollar, or at least has for the last little while. So you've got these higher highs, higher lows. We'd have to probably see it break to a lower low to assume that maybe that trend is reversing, or at least start kind of stair-stepping down with lower highs and lower lows. And that's just not happening yet. So we're going to assume that trend is going to continue to move higher. If we start to see it possibly reversing, I'll point that out. And the VIX. See, the VIX I was telling you, the VIX is showing no fear at all amongst the institutional traders, the big money traders. Now, again, the important thing to point out is that doesn't always mean that they're right. They're not always right, and that's why, again, though, it looks like we could still rally a little bit in the near term. Now, what I'd be looking for, though, is do we start to see days where the market is up and the VIX is up? Because that could be a signal that those institutional traders are starting to get a little concerned, and that and that's what we saw a lot before some of these other drops we've had, particularly back in the fall. Right before we had some of those sell-offs in the fall, we were having days where the market was up and the VIX was up, and it was kind of a signal that those institutional traders were starting to be a little bit concerned that the market was getting a little stretched, and sure enough, it was, and they sold off a little bit. Now, one quick thing I want to point out, I know a lot of you watch CNBC, and I can't watch it all day long because most of the time it's a waste of time. They're interviewing people that I'm never going to learn anything from, because they're going to only tell me the most optimistic view of their company, or they've got an agenda. They're trying to get people to go buy the stocks that they're in. They're fund managers, and they're trying to get extra people out there to go buy the stocks that they're in to help boost them up. But I happened to be listening to Jim Cramer yesterday, and he pointed out something that I thought was interesting, because it really one thing I've talked about a lot is that this market has reminded me a lot of the internet bubble of 2000. More the internet bubble than the financial collapse. The financial collapse was a different type. There were similarities, but it was a lot different. The internet bubble, though, was very similar to what's going on here, where you've got, like I said, back in the internet bubble, you had all these .com companies come out, and they didn't even have all they had was a business model. They were selling their stock based off of a plan to do something, not that they were doing it yet. We're going to sell diapers on the internet or whatever. And so people would give them money because they felt like that was a good business plan. That's going to work. And they didn't even have any production yet. They didn't have a product yet, but they had an idea. Well, what are we seeing now? Well, we've got all these electric vehicle companies right now that are coming out. There's a ton of them. And most of them don't even have an actual car yet. For instance, one is I'm trying to think of the name, but Nikola had an idea to have these electric trucks, transportation. There's big rig trucks that they were going to be hauling all the products around the country in. That was their idea. They didn't even have a truck yet, but it's still a stock, and people are trading it based on the belief that they're going to have this product eventually. Now, I'm not saying that they're not going to succeed or anything like that, but the similarities are very similar, are about the same as what we saw back in 2000, where we know that not all those .com companies survived, and at some point, I believe the market's going to flush out a lot of these companies as well. There's not going to be 15 to 20 electric vehicle companies when this is all shaken out. There's going to be 2 or 3 maybe, or 1 or 2. And Tesla's probably got the inside track on being at least one of those, because they already have a product that they're selling and actually making money on. But there's also the SPACs. And the SPACs are these companies that acquire other companies and take them public, and they can avoid the IPO process, which is a little bit more of a complex process. But the bottom line is, you've got all these IPOs, you have all these new companies coming public, you've got these SPACs that are taking companies public, and what that creates is you've got a market flooded with new shares of stock. All these shares of stock coming onto the market for people to buy. You still have the Microsoft shares, you still have the Amazon shares, you still have the IBM shares, and now you're flooded with all these other shares of stock. Well, what happened is that back in a year ago or so, or a lot of money flooded into those new companies. I know I started trading companies I'd never heard of before. In fact, if I look at the companies I'm trading the last 6 months versus the last 5 years, I bet there's probably about 50 or 60 companies that I were not on my radar, that weren't even in existence 5 or 6 years ago. But that's where I was going to. I was going into because those are the stocks that were moving. But we're at a point where there's, and when that happens, you see these small companies start taking off. What does that do? Well, human nature is that, hey, I want to participate in that. I can put together a business plan and set up a company and not make any money, but be able to sell shares. And I can make a lot of money doing it. I could buy a yacht or something, even though I don't have an actual product yet. And so the greed factor kicks in, and then you get too many of these new companies coming out. And what happens? Well, as we saw in the dot-com bubble, the market started to stagnate. It really took off in 1999 and early in 2000. It just went straight up. Actually, October, November, I remember 1999, the Nasdaq, you go back and look at it, but it was like straight up. The Nasdaq was going straight up. And then as we got into 2000, it stopped going straight up, but it was almost like it was teasing you. It would go up. It was still going up, but it was kind of flattening out a little bit. It was kind of we saw this happening, that there was just not enough money to be able to buy all the shares of all these stocks that were out there to keep them going up, because that's what you need them to keep them going up. You got to have more people buying it. And then what happened in about April we're going into April right now, so who knows? But April of 2000 is when it fell apart, and we had the internet bubble burst, and we had a pretty big drop in the Nasdaq. Now we didn't get as big a drop in the Dow and in the S&P. And again, I'm looking at a very similar thing. What are we talking about today? And I know I'm taking a lot of time on this, but what are we talking about today? We're talking about the Dow and the S&P trends looking okay, but the Nasdaq and the Russell 2000, where all these riskier stocks are, not as many in the Nasdaq 100, but the Nasdaq index and the Russell 2000, the small caps, we're seeing those start to roll over and possibly drop. So we'll see how this plays out. But I think if you want to study a little bit, and especially if you weren't trading in 2000, which I assume most of you probably weren't, it's a long time ago. But go back and look at some of those old charts and study the period a little bit, and find some of the similarities, and that's where I base a lot of my analysis on right now, is having lived through that and traded through that, gotten burned through that, try to use my experience now to hopefully protect newer traders coming in and getting caught up in the hoopla, because I got caught up in it back in 2000 and got burned pretty good when things dropped, when the bottom fell out. Now, real quickly here, and then we'll get into the training for today. There's only a couple of stocks I liked, and they're all kind of in the oil and energy sector. But remember, we looked at that oil chart, and it looked like it could have another move down. So I think it's very important you wait for confirmation on these. But oil and energy here. This WLL, Whiting Petroleum Corp, 99 strength rank. Let's turn the signals on here. Again, you have this nice move up here, and then you got this kind of consolidation, sideways kind of move. Now, one thing that could be going on is that this could be wave A, wave B, wave C, and it could take off from that. But this is kind of an intraday high right here. Here's where it opened, and here's where it closed that day. And then it did close higher up here. So it could be that this was a little correction for this move higher. This is a first move down. This is maybe wave B. And that maybe there's one more move down for wave C, which would fall along in the same line of the oil chart we looked at, USO there. So I probably think that's probably a little bit more likely to be the case. So that's why we're waiting for it to go back to a buy signal, but it could have that one more move down before it goes up. And then if we look at SM Energy here, ticker symbol's SM, 98 strength rank. Kind of a similar thing. This initial move down, it bounced a little bit. Looks like it's starting to move down again. That could be wave A, wave B. Get a move down into here for wave C, and then maybe it takes off again. So these are a couple just to keep your eye on. Because if they do go right back up, I said oil could just start taking off again, and this could go right back up and go back to a buy signal. Or you could even play it a little bit safer and wait for it to break out again to buy the breakout. Because if this stock were to get all the way back up there and break out, I'd be pretty confident that the chart of oil would be breaking out as well along with it. That's usually the case. All right, so there's a couple there. All right, let's get into the trading now. The trading today is we're going to kind of put together what we talked about on Thursday. We got into the covered call, and I'm just pulling something up here. And what I want to kind of do today is go through an example and also some different strategies that you could use with the cover call. That you could sell an in the money call and at the money call and out of the money call. Now, typically you're going to, especially when you're starting out, I would recommend selling out of the money calls. Selling at the money or in the money requires a really good understanding of your charts and reading your charts, being able to tell when pullbacks can happen. If you don't have that skill yet, you probably don't want to be using those strategies. But it's also, as we go through the examples and I show you an example of selling at the money call or in the money call, it could encourage you to really boost up those skills of reading charts and reading price action, because it could really benefit you in your strategies. So typically, you're going to sell the out of the money call, and in that case, your largest profit is going to be if you are called out or if that option is exercised on you and you're forced to sell your shares, because you'll be forced to sell them at a higher price than where you bought them, and that's always a sad thing, right? When you have to sell it for a higher price than what you bought it for. So, but that I'm going to show you an example of how your largest profit would be if you are get called out or get exercised on that option that you sell. By the way, if you don't know what I'm talking about, you'll need to go back and review the class last Thursday that I went through the examples of a cover call, what a cover call is. Today I'm just going to kind of focus on the going through an example. Now I'm going to kind of stick to the example that I was using. Let me pull up a chart of it too. That I use for the put as well, selling puts, BLNK. I still like that stock. Now I liked it right here. I had impulsive down, impulsive up, and it was kind of moving a little choppy right here. I thought it was going to take off right here, but it had another move down. So actually this ended up being wave A. That was wave B, and it looks like this is wave C. And we'll see if it moves off from here. So, sometimes you can get into these choppy conditions that just kind of keep going choppy, and then they take off. But so far I like that V-shaped move right here, and this looks a little bit corrective. So I'm still a little bit bullish on this stock, at least in the near term. It could be that this is a bearish wave A, wave B, and you get wave C up into this area here, and then it drops. So we'll keep an eye on that. But I think in the near term, this thing should rally up into this area, up around that $46, $47 area there. So let's assume that we're going to buy the stock. Stock was trading at 37, or actually 37.01 was let's use that one because it'll make the math. In fact, I'm just going to use $37 to make the math a little bit easier for us. So if I buy the stock, the first thing you need to do is you need to own the stock. So we're going to buy the share. We're going to buy 100 shares of BLNK. At $37 roughly. So 3,700. Now remember, you have to buy at least 100 shares to be able to sell a contract, because each contract of the option controls 100 shares of the stock. And so what you're committing to here is you're committing to sell you're obligated to sell your stock to that option buyer if they decide to exercise the option. And in order to be covered, so why we call it a covered call, you have to be able to have all the shares that need to that could have to have at least 100 shares. Now, keep in mind that I could have 150 shares of the stock, and I could sell one contract of the option. I'm still covered because only 100 of those shares would I be forced to sell if that option got exercised. I could have 500 shares of the stock and decide I only want to sell one contract of the call. I don't want to get called out of all my shares, but I'm willing to get called out of some of my shares. So just keep that in mind as well, that you have to have at least the amount of the amount of the contract you're selling. If I sell 2 contracts, I got to have at least 200 shares of the stock to be covered. But I can have more than that. I don't have to sell the same amount of contracts as I have shares of stock. Is basically what I'm saying there. Now, on a cover call, I typically like to go out the least amount of time as I can get away with. But the problem is the closer you get to expiration, the options aren't as expensive, so you're not bringing in as much. But I'm also not obligated for that long period of time. So in this case, I'm only obligated till Thursday, since the market's closed on Friday for Good Friday. This option expiration is Thursday, so I'm only obligated for 2 more days. Well, what could I bring in on those shares that I own? $3,700 worth of stock, 100 shares. Well, typically we like to use the out of the money option. So the out of the money option here, you have a couple of choices. You could sell the 38 call, or you could sell the 39 call. Now, how do you decide which one to sell? Well, one of the risks of selling your calls is you're obligating yourself to sell at that price. So if I think the stock could go up to $39 by Thursday, I'd rather go out and sell out a little bit further, because if I get called out, I'm going to make more money. I don't want to give up all the profit from the stock going higher. I'm bringing in less. I'd only bring in $47 as opposed to $74, but I'd make up for it in the stock going higher, being able to sell the stock for higher. So what I would do is look at the chart. I'm going to leave those drawings on here. Let's see if we can pull up the chart real quick. Here's $38. So $39 is right about in here, probably somewhere in here. It could easily get to 39 if the stock keeps moving up. It could maybe even get up to here to 40. The problem though with 40 is that, if we go back to our option chain here, is I'm only bringing $32. But if you think you don't want to give up that upside, you could. So in other words, what's happening here is the decision I'm making is I'd be bringing in less up front, only $32. But if it gets up above $40 at expiration, I would make more getting called out. I'd make more on the back end of the trade getting called out. If I sell the 38 call, I'm bringing in more up front, $74, but I'm going to make a lot less on the back end if I get called out. So you're trying to decide that balance. And there's no perfect way to do this. It really depends on how far you think that stock could go by expiration. And do you even want to get called out of your stock? If you don't want to get called out of your stock, you're trying to just you're trying to hold on to the stock for the next 6 months. Then go further out of the money and bring in less, but you're just bringing a little bit less every week, but you still own your shares. And now the reason why I don't mind getting called out is that I can always go buy the stock again. Nothing is preventing me from buying the stock. In fact, I'm going to teach you a strategy if I have time where you could use your selling puts to acquire your shares and then sell calls once you've acquired the shares and bring in extra money. It's like a whole big process there. And you can keep doing that over and over and over again. But so let's say that we're going to sell the 30. We're going to go right in the middle here and sell the 39 call. We want to make a little bit more up front, but also be able to keep that intact, that money intact for getting called out. So I erase my drawing up here. So we have 100 shares at 37, 3,700. All right. So if I sell that one contract, I bring in 47 cents times 100, so it'd be $47. And I get to keep that money no matter what happens. That's a very clear drawing here. That's a 7 and this is a 3. All right, that looks a little bit better. All right. So $47 divided by 3,700 is a 1.2% return for 2 days. Not bad, especially when you compare that to what you're making in your savings account at your bank or whatever. Now, what if the stock does go up? Well, what if the stock doesn't go up above $39 by Thursday? Well, I get to keep that $47. I get to keep my stock, and I would immediately go look at the next week options, the April 9th options, to see what I could get selling the 39 or maybe even the $40 put out next week. Bring in another 50 bucks or whatever. What if it goes above, what if it's at or above $39 on Thursday at the end of the day when the market closes? Well, I'm going to get exercised on that option, and I'm going to be forced to sell the stock at $39. Now, boo-hoo for me. I bought it for $37, and I'm going to be forced to sell it for $2 more at $39. I'd make an extra $2 on those 100 shares. I would make $200. So if I don't get exercised, I'm going to make $47 and keep my shares, and I can sell out the next week and keep doing it. If I do get called out, I'm going to make the $47 from selling the call and the $200 from being forced to sell my stock at a higher price. I'm going to have a $247 return. And $247 divided by my 3,700 is going to be a 6.6% return for 2 days. Now, what if I would have sold the $40 call? I would have only brought in $32 up front. But if the stock was at or above 40 by Thursday, I'm going to make $3 from 37 to 40. I get to make $3 premium, or $3 from getting forced to sell my shares. That's $300 I'd bring in, or I'd make $332 overall. If I sold 38, I'd make $74 selling. So I'd make more up front, $74 selling the put or selling the call, and then I'd only make $100 if it gets above 38. So it'd be $174. So that's the decision you're making. Do you bring in more up front, make less on the back end? Do you bring less in up front but make a lot more on the back end, or do what we did, kind of do in between? There's not a wrong decision. It's whatever you feel is best for that situation. usually I kind of recommend going, one or two strikes out of the money. You always want to make sure you're at least bringing in a decent amount. Now with the commissionless trading, it makes it a lot easier to make your premium worth it. When we had, $15, $20 commissions back in the day, you're bringing in $47, but you're paying $20 in commissions. You're only making $20. It's $27. It really, in many cases, wasn't worth it. But with the commissionless trading now, or the really low commissions, some are just really pennies now for commissions. It makes it a lot more worthwhile. You can actually make something selling those options. Now, what about an at the money call? Well, if you just wanted to bring in premium, you think the stock is going to at least be flat or go up, but you're just chasing the premium, you could buy the stock at 37. You could sell the 37 call and bring in $116. You're probably going to get exercised, and you're not going to make anything on the shares. You bought them for 37, you're selling them for 37. Now, usually, if you're going to sell the at-the-money call, what'll happen if you're going to sell the at-the-money call is you probably bought the stock earlier. I probably bought it at 30. Let's just make the math easy here, 30. And I want to get out of it right now or this week. I don't care if it goes up much higher. So I just sell that 37 call, bring in that $127 or whatever it was, and I'm going to probably get exercised. I get exercised. I'm forced to sell at 37. I bought it at 30. I make that extra $700. So I was already wanting to sell, but I wanted to go ahead and bring in a little bit of extra money to get paid to sell. I want to get paid a little bit extra to sell my stock. Now, the danger is it could drop. What if it dropped down to 35 by Thursday? Well, then that money you brought in, that $127, hedged you a little bit. It lessened the loss a little bit. It lost in value of your shares going down. But that would be kind of a situation where I would maybe sell an at the money call, as if I bought it earlier and I'm ready just to get out, or if I just wanted to pick up premium pick up that $116. If the stock stays the same, I'm still get to keep that $116. If it goes up, I still get to keep that $116. If it goes down, then that $116 could hedge my loss a little bit, as long as it doesn't go down below, would that be $35 and 84 cents? Is that right? My math? But you're rarely going to just go buy the stock and sell the at the money call. You'd be better off to at least going one strike out, make a little bit more if it continues to go up in value. Now, what about an in the money call? What if I sold the 35 call? I can bring in $227. Well, you don't want to go buy the stock at 37 and then obligate yourself to sell it for 35. You're already above 35, which means you're going to get called out. And in this case, you would lose $2, right? Now you're bringing in $227, so you'd at least be able to make $27, right? The $2 would be the loss of the stock there. So you say, well, why would I ever sell an in the money call? Well, there again, if you bought the stock at $30, and you could sell an in the money call if you felt like the stock. Usually, you're going to sell an in the money call if you feel like the stock is going to drop. And this is where being able to read a chart could be very helpful, because let's say I'm holding the stock. One of the dangers of cover calls is that you sell your call and then you give up your upside. So the stock starts to move up, you sell a call that gets you out of the stock right here, and then the stock makes this huge move up right here. Yeah, you made a decent amount on the call and the stock moving up, but you missed out on the big move. So when you know how to read a chart, you could buy the stock and you're going to stay in that stock until you get a bearish reversal signal. Here's a pretty strong bearish reversal signal right here where it gapped up and then sold off, closed lower than where it opened after a big run up. That's a bearish sign. That stock could pull back in the near term. Okay, well now you could, the stock's at $47 at the end of that day. Now you expect it to pull back. You don't want to give up your stock still, but you maybe make a little bit of money on the pullback. You could sell an in the money $35 call or something like that. Bring in a lot of premium right there. And yes, that stock pulled back. But what if it pulled back and then went below the stock, the contract that you sold? By expiration, you'd be able to keep that big premium and keep your stock for it to go back up again. Or, and you say, well, yeah, but what if it doesn't go down that far? Well, here's another thing you could do as well. Let's go back to the option chain. Let's say that I get a strong, that I own the shares at $37. And there's a bearish reversal sign that shows that this stock could pull back or should pull back within the next couple of days. I could sell the 35 call, bring in $2.27. And let's say, sure enough, that stock drops down. Let's say it drops down to $36. So I'm still in the money, right? And, and maybe that was just a quick pullback and off of that bearish candle. And now I'm worried it could go back up, and I just obligated myself to sell the stock at 35. Well, as that stock dropped down in value, what happened to the value of the option? It's going to go down in value. As that thing dropped down to 36, let's say that option is now worth $1. I sold it at $2.27. Remember, we sell to open the position. We sold to open the position. That option on that the stock dropped. Now that option is worth $1. I could buy it back. I'd have to buy it back at the ask price. That ask price, I'm assuming, is now dropped with the stock going down. Let's say I bought it back at $1. Once I buy it back, I close that option position. I no longer have that obligation. So I brought in $227 because that stock was showing a bearish reversal candle. The stock dropped, but it's a very short-term, might be a very short-term thing. I don't know if it's going to drop far enough by expiration, but it dropped enough to where I could buy it back at $1. Now I've closed out that obligation. I've spent $100 to buy it back. In one day, I made $127 profit on the shares that I'm owning and wanting to go up for the long term. Not to mention the fact that what that does is when you got that bearish reversal candle, you sell that option, it drops, you buy it back. You've hedged yourself on this drop. I don't know if this drop's just a pullback and we're going to go higher. What if it ends up being deeper? Well, if it ends up being deeper, I might at some point have to stop out of the trade, but at least I brought in that extra money to help with that loss as it dropped back down, or help on the profit I gave back on that dropping back down. Because even if I bought it right here, when it started to drop back down, I'm giving back some of the profit. So to protect yourself, you could sell that call. And you don't have to buy it back immediately. I could sell that in the money call. And then here was kind of a bullish reversal day where it opened lower and ended up closing higher after a drop like that. So that's kind of a bullish reversal candle. I could say, oh, maybe I need to buy this thing back now, because this thing might be ready to go back up again. So that would be where I would use the in the money option. But you see how you have to kind of be able to read the charts, read these pullbacks. There's a bearish reversal signal right there. Now, if you want to put all this together with the selling puts class, I could sell the 38 put. I don't own the shares yet. Let's sell the 38 put. Or actually, we'd sell right. We could sell right at the money or out of the money. Let's sell right at the money. Let's say I'm ready to buy it right now. So the stock's at 37. So let's sell the 37 put. I like the stock and I like it at that price. Remember the rules of selling puts. Out till this Friday would be, I could bring in $1.36. So I bring in $136. If the stock keeps going up by this Thursday, I get to keep that $136. I could sell out till next week, bring in another $136. If it is at or below 37 by this Thursday, I'm going to be put the stock. I'm going to be forced to buy the stock at $37. So I buy those shares. Let's say it does drop a little bit. I buy those shares, $3,700 to buy those shares. And then I look out next week and I look at the 38 or 39 calls out next week. And well, that's actually out 2 weeks, and I start selling cover calls. Maybe I bring in only $75 or whatever. But if it keeps going up and I get called out, not only do I get to keep the stock goes to $39 and I get called out, not only do I get to keep the 75, but I get to keep the $2 profit from it, selling it higher, $2 higher. So that's $275. And then what do? Well, okay, I'm out of the shares now. Let's sell some more puts to acquire more shares. As long as I think that trend is going to continue to go up. Or I sell the puts to acquire the shares and I wait for Blink to go up to where I get a bearish reversal candle. And then I sell in the money call, wait for it to pull back, and then buy back that call, make an extra money there, and then let it run again. And so what I said at the very beginning of this, I said, even if you're not wanting to be a traditional buy a call, buy a put option trader because you think that's too risky, I always tell people that want to trade stocks and want to get good at trading stocks, you got to learn to trade options with it because you can do some very safe option strategies that can significantly increase your performance. If that stock is already going to go up like you think it is, why not get paid the extra amount? Why are you buying your house, letting it sit empty for 5 years, selling it for a profit, and then claiming you're a great real estate investor? You're not. You should have put renters in there for 5 years and brought in even more. Well, if you think the stock's going to go up, learn how to sell calls to make extra money as that stock is going to go up. Learn how to sell puts to acquire shares again if you get called out. All right. We'll leave it at that because we're really, really late today. Hopefully that's helpful, though. I don't have a topic for the trading on Thursday yet. Let me think that over, and I'll tell you at the beginning of the update on Thursday what that is, what the training is going to be on Thursday. All right. Thanks, everyone. Have a great week. See you on Thursday. Bye now.